What if I told you that the most powerful form of money today isn't printed by governments, controlled by banks, or regulated by global institutions? What if the currency quietly reshaping the world doesn't exist in physical form at all? No coins, no notes, just lines of code. A currency that operates beyond borders, beyond authority, beyond oversight. A currency that governments fear, not because it's unstable, but because it undermines the very control they've spent centuries building. The mystery is simple. Why are some of the world's largest financial powers scrambling to regulate, ban, or even replicate something they publicly dismiss? And what does it mean when ordinary citizens, armed only with a digital wallet, can bypass decades of entrenched monetary control? Today, we're going to explore decentralized money, how it works, why it threatens old systems, and what it could mean for the future of global power. For thousands of years, money was tangible: gold, silver, and other physical commodities. Value was grounded in scarcity and trust in its physical properties. Governments and banks acted as gatekeepers, ensuring that money flowed according to their rules. With the invention of paper money in the 1600s, that trust shifted. The promise of value replaced the physical commodity. Central banks emerged, clearing houses formed, and payment networks like SWIFT became the arteries of global finance. Power was concentrated in the hands of the few. Governments controlled monetary policy, banks controlled credit, international institutions monitored global transactions. Money wasn't just currency, it was a tool of influence, control, and dominance. Yet history shows a consistent pattern. Every time a technological or financial innovation challenges the status quo, old powers resist, then adopt, then adapt. Coins replaced by paper, telegraphs replaced by digital transfers. Credit cards replaced cash, and now, for the first time, decentralized money threatens to rewrite the rules entirely. The idea of money outside centralized control isn't new. Cryptographers in the 1990s, the so-called cypherpunks, imagined a world where financial freedom existed without oversight. They wanted money that was anonymous, borderless, and immune to arbitrary state control. Early attempts failed. Centralized servers could be shut down. Governments could freeze accounts. The dream of fully decentralized digital cash seemed impossible. Then came 2008. The global financial crisis exposed systemic weaknesses. Banks collapsed, governments bailed out failing institutions, and ordinary citizens lost faith in the system. Out of this chaos, a pseudonymous developer known as Satoshi Nakamoto released Bitcoin, a peer-to-peer electronic cash system. Bitcoin was different. It operated without banks, without governments, and without permission. Scarcity was enforced by code, trust was decentralized across a network, and control was no longer monopolized by institutions. Bitcoin's early years were dismissed as a hobbyist experiment. Prices rose slowly, $1, then $100, then $1,000. Enthusiasts realized that it wasn't just digital money, it was digital property with inherent scarcity. Governments began to notice people could now store wealth outside the reach of banks. Cross-border transactions became possible without oversight. Entire industries, lending, trading, insurance, and savings were being reimagined on decentralized networks. Ethereum introduced smart contracts enabling programmable money. DeFi platforms allowed lending and borrowing without banks. Stablecoins created digital dollars independent of central banks. NFTs created proof of ownership on blockchain networks. By 2021, the crypto market surpassed the GDP of most nations. Old powers faced a dilemma: fight the innovation or embrace it. Many tried both. China banned crypto trading and mining. The US imposed regulations. Europe pushed CBDC initiatives. Yet major banks quietly built crypto trading desks and custody services. Even regulators were forced to admit You cannot stop decentralized money, it can only be integrated or competed with. The emergence of decentralized money created tension across three layers of global power. Governments and central banks saw it as a threat to control and monetary sovereignty. Private corporations saw both a risk and an opportunity to profit. And decentralized communities saw a chance for financial freedom. This was unprecedented. Never before had ordinary citizens gained access to tools that could bypass decades of centralized control. The balance of financial power was shifting from institutions to networks. As adoption accelerated, the risks of fragmentation became clear. Without a unified system, competing currencies, corporate tokens, CBDCs, and decentralized protocols could coexist but not necessarily interoperate. A single global monetary authority was no longer guaranteed. We are already witnessing the consequences. Global capital flows are diversifying beyond traditional banks. Countries like El Salvador recognize Bitcoin as legal tender. Institutional crypto investments are expanding rapidly. Younger generations increasingly favor digital assets over traditional accounts. The power of old institutions is diluted. Central banks still control monetary policy, but their influence over daily financial transactions is declining. Corporations have new leverage. Communities can pool resources, create decentralized governance, and bypass intermediaries entirely. The financial ecosystem is becoming a battlefield of competing powers, states, corporations, and decentralized networks. Control is no longer centralized, it is distributed. Traditional attempts to contain decentralized money have largely failed. Regulatory crackdowns temporarily slow adoption, but often drive innovation elsewhere. Central bank digital currencies offer control, but adoption is slow and trust remains limited. Private blockchains increase efficiency, but cannot replicate the decentralization that gives crypto its disruptive power. The fundamental challenge: people now have a choice. Money is no longer tied solely to governments or banks. The genie is out of the bottle. This is not unprecedented. Throughout history, technological shifts decentralized power. The printing press diminished the church's control over information. Paper money challenged gold's dominance. E-commerce disrupted traditional retail monopolies. Each time, incumbents resisted, then adapted or failed. Decentralized money is following the same trajectory. Adoption continues, infrastructure expands, and power slowly redistributes. Over 350 million people hold crypto globally. The market has exceeded $3 trillion at times. Institutional interest continues to grow. The momentum is undeniable. Control over money is shifting from governments to networks. Decentralized systems challenge the monopoly of trust once held by central authorities. All financial powers are scrambling to adapt. Central banks, global institutions, and corporations are racing to remain relevant in a decentralized landscape. The future of money will be pluralistic. Multiple competing systems, hybrid models, and networked currencies will coexist, defining a new financial ecosystem based on choice, not monopoly. The most dangerous assumption is believing this change will be slow. Technology moves in bursts, not linear steps. Just as smartphones replaced multiple industries overnight, decentralized money could redistribute global financial power faster than anyone predicts. The real question isn't whether crypto will succeed, it's which institutions, governments, and communities will survive and thrive in this new paradigm. If you want to understand the forces reshaping money, finance, and power in the 21st century, make sure to like, subscribe, and turn on notifications. Every week, we dive deep into the hidden mechanics of the financial world and decode how technology is changing everything you thought you knew about money. Because in a world of decentralized money, what you don't know can cost you far more than what you do.